You're listening to the REITE Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at thereiteclub.com. And now your hosts, Sarah Larby and Alfonso Salemi.
Now, you mentioned property manager. Do you have an in-house property management person that is just employed by you and Larry? Is that what you're saying?
Yes, we created, so under the umbrella of properties, we created almost an asset acquisition company, which we then transition over the assets to the construction company that we have. Then we easily transition them over to the property manager. So really, when I'm buying the property, I already have the property manager that's placed the seed, knowing the type of asset that we're creating. So he's already looking for the tenant. Then we bring in the construction company at the time that we're buying it, and we're placing that project in their project timelines. We're allocating the manpower, and so it was the first thing that we ever did. So yes, to my joint ventures, there is a property management fee. I oversee the management of the asset. I don't oversee the management of the toilets. You don't want me managing toilets. You want me managing your asset, making sure that it's performing at its highest and best use. Yes, I can make money off of my construction company and off of my property management company, but trust me, sweet peas, I don't make money. Like, that's not where wealth is created. And it's very small, myopically focused people that think, well, I'm not doing a deal if you're the contractor. No problem. But you look at it and you go, the more, I don't know if you know about Polis Investing Fund. They buy large apartment buildings. They do what we do in the large apartment buildings. So they pride themselves on having an in-house construction company that walks through when they're buying the property. They pride themselves on having an in-house leasing manager that manages the tenants on all of these properties. So the more seamless you are, that there's no gaps in between. You know, like, we get mad if we have tenants coming through when the renovations are still going on. Well, that's only allowed because we're the construction company. Can you imagine an outside construction company going, you can't bring a property manager through here? And I'd be like, well, actually we are, because it's you and it's us getting paid for the tenant. And so anyways, long story, yes, it is one of the first. We offer superior property management to all of our joint ventures for a fee.
And I love that integration. You're just controlling that whole process, right? And you mentioned somebody that might not like that. I actually prefer that, because if you're my partner, you're saying, hey, you're also the construction company and you're also the property manager. Like, we have a full visibility on everything. Isn't that more comforting versus, well, I don't really know these guys? And I think that maybe comes from, and I know you have this mindset, that abundance mindset versus that scarcity mindset. Most of us real estate investors, we always like to think, there's more opportunity, there's more room for growth. And, I think early on, if you don't wrap your head around, hey, it's okay to have half a watermelon and then a whole grape, right? And that's kind of the mentality that a lot of us have to have, is that we can do more work together and accomplish more together, working in that sense, right? So what are some things that, you work on day to day? How are you going out and finding, those amazing properties and on a day-to-day basis? So like you said, you expanded outside of Midland, you're in other cities as well too. You probably built up some power teams in different areas. I know Sarah has as well too, when she's working in different cities. So what are some things that, an investor can go and do today to go and implement to find a good deal? I know, we don't want all your tricks and tips and secrets, but what are some tips that they can put into action today?
Success leaves clues. So if you want to be like Alfonso doing rent-to-owns, be on your email list and watching, where are the deals, what are they analyzing, what are they looking at? There's a new coaching group out there, and I've had a lot of people, and they're all about cash flow. Well, where's the 1% rule? Your properties don't work under the 1% rule. And I was like, I don't know if you realize, but we're in Ontario here, and that typical 1% doesn't necessarily work here. Well, does that mean it's wrong? No. So success leaves clues. If I'm going to tell a new investor, if you're trying to stay within your means, you're probably going to go to one of the small markets, which is Windsor, which is Thunder Bay, maybe Sudbury, up there where their money can go the furthest. Or you say, I want a solid return. I want a solid city. I'm not speculating on appreciation. You're not buying in Hamilton to speculate. You just know that it's just solidly there. I would do what other successful people are doing. I remember a good friend of ours, and they had a strategy, and then I was like, hey, cool, that's a good strategy. Maybe it's time to pivot because look at all the people that are doing single family conversions right now. It obviously works. Don't say, well, but I'm not sure if it works. Hey, you can have that question over there and go find the answer. But over here, I'm going to tell you that 80% of the people are buying single families, converting them to legal duplexes. So you think that strategy works? I'm pretty sure it works. Now, every municipality has their own little nuances. So I'm definitely telling people to start to reach out, ask some questions. But success leaves clues. Do what other successful investors are doing.
Yeah, absolutely. And I love that you mentioned the 1%, because when you are in Southern Ontario, it's very hard to get. Unless you're going to, like, you know, very, very far north communities or something along those lines.
There's another point though, right, Sarah? It's hard to get. And people are like, you know, I don't have a sheet in front of me, but people are like, well, the pro forma, there's no 1% on this. No. 1% are created, because I bet you guys have created the 1% rule, but you didn't buy it at the 1% rule.
Correct.
So yeah. There's this like timeline. Give yourself 2 years, people. Like give yourself that, you know, so that's why the mentality around how fast can I get my money out is good to have, but then it takes time to build money in real estate, at least 2 years here.
And I'm glad that you mentioned that, because one of the things that I do is I like to find tenants that are not lifers, right? Because in Ontario, we're very limited to how much we can increase year over year. And this past year it was 2.2%. But once they turn over, you know, the rents increase on market rents. Like if you were to move out and find something else, is like, you know, in some of the neighborhoods that I'm investing in, 10% or more. So once they're out after 2 or 3 years, like sometimes I'm getting a $400 or $500 lift on just the increase. I'm like, sweet. So one of the things I screen is for tenants that have a goal of buying their houses or like moving at some point to something different. But if they're like, I want to live here forever, this is my forever home, unfortunately, you could be the best tenant in the world, but it doesn't work financially. And this is a business at the end of the day.
Yeah, absolutely. Now I do have the lifers. I do have certain properties that just works in, but that was the strategy around that property, and away you go. So I would tell you that the majority of my portfolio, and now keep in mind, like we're talking 160 units is what's in my portfolio right now. So those aren't all A-type tenants, but I love my B minus tenants. They're everybody's a beautiful person. And so the larger you go, you are going to have to acknowledge, I have people who are on disability. I have government checks that come directly to me that get direct deposited, you know, people who are on Ontario Works, all of that stuff. No judgment on these people. But you realize that as you continue to build a portfolio, it's not all butterflies and rainbows, and you are gonna, you know, the odd property, the odd person gets in there, and next thing you know, they are a lifer. How do we get them out? You don't. You know, there's just.
I do agree. Like, I mean, not everybody is. You got to look at your like your whole entire portfolio. I will say though, there are some, and I have absolutely nothing against the disability payments. I think they're great. Like some of those tenants are amazing. Like they pay on time, you know, but they will be there for a while. However, to get the 1%, you know, that is a different strategy. So overall portfolio, fine. But if you're looking at that 1%, this is the tenants that you need to have kind of more of a rotation.
Yeah. Sometimes though, maybe that's a good opportunity I can put in there for new investors, is there is an opportunity to be able to buy properties under market value if you take over the tenant. So I kind of have a bit of a hard spot if somebody's like, well, that'd be a great asset. I just need all the tenants to leave. And I was like, I don't know. Why don't you go tell your grandma, your aunt, and your uncle that they all have to move out? So you can make more money. Like it's a human thing here as well. And so, you know, I'm sharing with people, if you want to be able to make money in the buy an underperforming asset. And you know what, you could pay these people an amount of money they've never had, kind of like their own Lotto 649 without getting struck by lightning, and offer them cash for keys at an amount that makes sense to them to leave. And it makes sense for you because you negotiated such a discount on this asset. So, I mean, you start at 5,000, but I tell people 10,000 is my max. Can you imagine if you bought a property for 50,000 under market value for a duplex, and all it cost you was 20,000 to get those people out? And so you still have a $30,000 lift. Now, psychologically, to yourself, the investor, you have to realize that you're paying somebody to be able to leave, but that value is significantly higher than what you're paying these tenants. I had a gentleman that we went and bought his washer and dryer. We knew his son, and we went over, bought this unit for one of our properties. And he was complaining that, these tenants took him for a loop and, $10,000. He couldn't believe the damage that they had done to the unit. And I'm looking around. I said, when did you buy this property? 3 years ago. How much did you buy it for? 300 and some whatever. And I was like, what's it worth now? 600. And I looked at him and I was like, you just made $300,000 and all it cost you is $10,000 in renovations. And he slides his head over and he's like, nobody has ever put it to me that way. I'm like, I know, welcome to my world, right? So stop complaining about the 10 grand because I really don't give a crap. I'm excited for you to have made 300,000 at the same time that tenant paid your mortgage down and all it cost you is 10 grand in renovations. So like when you have the bigger picture in mind, if you can really negotiate that asset, pay somebody 20 grand for 2 tenants to leave, increase the market rents, just as you said, by $300-400, and increase the value of your asset, you probably just made 100 grand and all it cost you was 20.
Thanks for listening to the REITE Club podcast and joining our community of real estate investors online at thereiteclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.